Okay, now some of you are kind of better known than others, but we'll just start by getting you guys to tell us a little bit about yourselves and your organizations. Philippe, since you're on the end there, why don't you kick off?
Yes, hello everyone. I'm Philippe Collombel, founder and managing partner for Partech Partners, pan-European VC firm investing anything from seed to Series E, which means from 500K tickets to 40 million tickets. And we have over 30 fintech investment in our portfolio.
Can you maybe tell us a couple of them?
Yeah, anything from TOS, multi-billion neobank in Korea, up to we are investor in Gotkine, we are investor in Alan, we investors in October, we investor in Cantox, we are investor.
Okay.
A lot of the European fintech companies.
Okay, Daniel.
I'm Daniel Schrein. I'm CEO of the European open banking platform Tink. We'd like to think ourselves as the rails and the brains of open banking, meaning that on the rail side, we connect now 2,500 banks across 13 markets to do account aggregation and payment initiation. And then on top of that, we build data services that help our customers to kind of use this infrastructure in the most and best way. And it's all a platform as a service where we help the likes of Klarna or PayPal, but also the Nordeas and RBS and BNP Paribas to be a winner in open banking. We're 300 people across 10 offices in Europe.
Nikhil?
Good morning, my name is Nikhil Rathi. I'm Chief Executive of London Stock Exchange PLC, so that's the UK equity market part of London Stock Exchange Group. Major international exchange, in the last few years seen real growth in fintech companies coming to the market, starting with WorldPay in 2015 in the payment space. Last year around 21% of capital raised on the LSE was for fintech, and increasingly we are ourselves investors and partners in fintech. We took a small stake in an emerging fintech called Nivora last year, which is working on automating documentation processes for raising capital.
Hi, my name is John Doran. I'm a general partner with TCV in Europe. We're a global investment firm, originated in the Valley, but really with a global mandate. About a third of what we do is enterprise software, about a third is internet, and about a third is fintech. We've been investing in fintech for more than 20 years. Kind of first wave of companies was businesses like Investnet, Market Access, Riskmetrics Group, and more recently we've been investing in the second wave of kind of disruptive players, both on the enterprise side as well as the consumer side. Enterprise companies, businesses like Axiom SL out of New York, Payoneer. I'm on the board of World Remit. Yeah.
Okay, and Ryan.
Good morning. I'm Ryan Gilbert. I'm one of the co-founders and managing partners of Propel Venture Partners in San Francisco. We've been around for the past 4 years, backed by BBVA Group out of Madrid. We focus on late seed and early A in fintech investing primarily. Some of the names we've invested in that you probably know here are Coinbase, Trussell out of the UK, DataSign out of Belgium. And good to be here. Thank you for your time.
Okay, well, thank you, gentlemen, for those introductions. Now, there are obviously many ways that we can fuel fintech growth, but I guess money is one way, and perhaps arguably one of the more important ways. So I guess maybe since it's the most obvious one here, Nikhil, will start with you. I guess you would make the case that public markets are a great way for fintechs to raise money, especially if they're at a certain size and certain stage, in order for them to continue their growth. Would that be your perspective, perhaps?
Oh, for sure, yeah. So I would say, well, look, I'd say London Stock Exchange Group, we would you could describe us as a fintech, and we've done pretty well on the public markets as we're growing and looking to acquire more businesses. But on a more serious note, what we have seen in the last few years is, particularly in some segments of the fintech space, the public markets being very attractive when it comes to exits and raising capital. Payments being the most obvious one. I mentioned WorldPay coming to market a few years ago. Last year in Europe, 2 of the biggest IPOs were for payments companies. Nexi in our sister exchange, Borsa Italiana, raising 2 billion euros. We saw Network International, largest Middle Eastern payments company, coming to London and raise capital. And you're starting to see the equity markets understand these companies, value them appropriately with the research and analysis around in the ecosystem. And what's also important is that for a management team that meets their expectations, the equity markets are proving to be pretty effective at helping them raise further capital to grow and acquire. And we've seen a number of those situations as well. At the smaller end, we've seen, as I said, 21% of the capital raised last year was for fintech. We've got a growth market framework in AIM in the UK. We've seen companies from the West Coast actually come and raise capital through that platform as well. All of this works in complementarity with VC and PE, which also have their place too.
I mean, what size? I mean, for the main market itself, right? I know we've got obviously the alternative investment market, but in terms of the main market on LSE, what kind of size would you be kind of aiming at or encouraging most to kind of join you for their exits, for their IPOs?
There's no sort of kind of hard and fast size threshold. You have companies as low as 50 to 100 million coming through, but we've seen exits at 250, 500 million up to 4 billion.
Okay, and Philippe, in terms of you're a VC, so I guess you're a big fan of VC money, but where do you kind of step in, and how do you ensure that your kind of money obviously finds the right companies to invest in for yourselves, but also where it can, I guess, do the best and the most important work?
I think there is obviously a changing landscape of financing. You have, of course, the VCs. You have the large strategic investors. And I think we will probably speak again of the Chinese money, for example, the Tencent doing a major operation in Europe, it's especially relevant for the European fintech scene. We have the banks, and we have some very interesting example even in our portfolio. BNP and a very large US bank investing in a company such as Cantox, for example, trying to do strategic partnership. And I think that's very, very new in the environment. Banks changing their position from basically trying to fight against the fintech. And I think both parties understand that there is a keen interest in cooperation, and that's pretty new. We have private money for some very wealthy families, the family offices. They come to the table. Last but not least, some hedge fund managers, very latecomers to the game, probably a bit burned after WeWork and some other important events that happened in the last 6 months. That means that VC money is still extremely relevant. In my view, should be the base of your financing, of the financing amounts of any round, but it's very important to attract other investors in your cap table. I think the time where we are saying, it's us against them, it's over. Clearly a changing landscape. We need to, now in Europe, what is important is to build probably between 10 and 20 very solid unicorns. It has started. Aldion on the stock exchange is a great example. We need more of them.
And Daniel, I mean, for you, it's Visa. I mean, how much have you guys raised so far?
We raised 90 million euros last week announced. I think we raised below 200 in total, at least. I think that the stage where we are, it's not. I'm not attracted to the stock market. It seems complicated, and sorry for saying. I think that the kind of bets and the kind of execution mode that we are in right now, then it's extremely helpful to be able to attract both the money, but also the competences from what the VCs can bring at this stage. I'm very happy with that.
And John, I mean, Philippe mentioned WeWork, for example, as I guess the most high-profile debacle in recent years. But we've also seen, not in fintech necessarily, but you've seen the likes of Uber and others that have stayed private for a very long time and then have come to the market and then disappointed. Does that change the way maybe it's not? I mean, do you think that staying private, VC backed for longer is is still a good way of approaching things, or do you now, in the wake of that, kind of have you changed the way that you approach your investments in the wake of some of these kind of disappointments that we've seen?
Yeah. So I think, first of all, we all make mistakes. I don't want to point fingers at other investors. We weren't in any of those three, but obviously there were issues. I think the way I think about it is, we at TCV, our approach is, let me make one point first, actually. I think Philippe made a very good point, which is that there's a lot of what we kind of think about as like newer money in the category. A lot of that new money will rely on guys like us or guys like Philippe, I think, to lead around and try to follow in behind, whether it's family office or sovereign or so forth, or maybe don't know the category as well. And I think that's definitely true. And I think what'll be interesting to see is when we go through, I mean, well, I saw something last week on at Davos when the CIO of Bridgewater said that the boom bust cycle is over. I'm not sure I agree with that, but I think if we go through the cycle, it'll be interesting to see how these to see how all of us perform, to be honest, because I think we're going to talk about pricing. Pricing's been very high. From our perspective, to answer your question, what TCV tries to do, our average ticket is kind of 100 million plus, right? So whether that's investing in Nubank or in other business like that, what we're trying to do is identify the best businesses with great teams, big markets with tailwinds. And so whether it's a private company or a public company, it really doesn't matter to us. We do both. We'll invest. We've 10 to 20 public investments. That said, I would agree with what Daniel said, which is I think there's a time and a place to be public. And so I actually had breakfast with a CEO this morning in the fintech space, and he mentioned something that I hadn't thought about before, which is he was showing me a public company that's growing 80, 90%, 100% successfully, where there's the public market values it the way it should be valued, and also they're able to do what they need to do. And that's why I would kind of challenge you. I think there's a time and a place, and I actually think every company ultimately should aspire. I think of ourselves as kind of a growth equity PE late stage VC firm, but we're not the end capital, right, for a company. I think the end state is either a public company or part of a bigger entity. And so I would argue that there's a time and a place for being public. I think the companies that you mentioned should have been public or should be public because that scrutiny is needed. But I would also argue that there's companies, I'm guessing Daniel's company, the growth that you're experiencing, public market listing just doesn't make sense at this point. I think it would be a very bad idea.
And of course, originally on this panel, we're also due to have Jacob de Geer from iZettle, which of course was bought by PayPal for $2 billion. So I guess that was the kind of another option at the end in terms of the end capital. But Ryan, when we spoke just the other day or last week, you were talking about not only kind of about not just putting money, because money is money, like $1 million is $1 million. It's kind of what comes with that money. And then you also surprised me by talking about how debt financing is a good way for startups to raise money, seeing as you're a VC yourself.
Well, money is money, and once I put money in a company, I'm very concerned about what is being done with the money and how efficiently we're focusing on the financing. And that's why we're always reminding our early stage portfolios about the importance of understanding both equity and debt. And there are some very active debt sources of capital, Silicon Valley Bank, most well-known where I come from in the Bay Area, who provide both great value add and very affordable capital to our companies to enable them to grow. I think when you're looking at future financing to support the growth of your business, much like there are capital markets and stock exchanges, think about banks and financial services and lenders as part of the capital stack.
Okay, but of course, with all there is still a lot of money going into all of these startups. I mean, as Daniel was just telling us, they raised 90 million euros just a few days ago. But Philippe, you were talking about now because of a lot of the money these startups have raised, the valuations have gone so high that some of the kind of end capital, as you put it, John, is kind of some of those routes have been closed off, especially in Europe, because traditional buyers, let's say maybe banks, simply can't afford them.
I think that's a pretty important topic for this panel. Yeah, what we are experiencing in Europe is basically low valuation for the capital markets. It's a paradox because people says the stock exchanges have recovered, but when you look at the market cap of the large European banks versus the large US bank, it's astonishing, the difference. BNP, probably one of the largest European banks, or one of the two largest European banks, is worth something like 70 billion. JP Morgan is worth 400 billion. SocGen is worth 20 billion. And a famous startup, Adyen, is worth 30 billion. This is raising very, very important issues. Who is going to buy in Europe the successful, and I insist on successful, fintech companies? We collectively, as the ecosystem is really growing very nicely. What I find amazing is that most of the portfolio of our portfolio companies, but I'm not speaking about Partech, I'm speaking about the ecosystem. Most of the well-funded, well-managed companies are executing on their business plan. They are experiencing huge growth. And what's coming next? In my view, private equity is going to play a very important role, because I agree with you, public market is probably not the solution when you are growing that fast. And probably outside investors, I mean, once again, either US acquirers or Far Eastern acquirers, which is really, really raising the issue of the future of the European fintech financial landscape as a whole. Not only the fintech landscape, the financial landscape.
Ryan, you wanted to come in there?
I'll sum it up by saying that valuations are crazy right now. And we're seeing the valuations of pretty early stage fintechs in the United States that are trading below what ultimately would be the public pricing that they would get. I don't see how these $2 billion and $4 billion companies are ever going to achieve that on a public market basis. The biggest worry I have right now is the lack of takeouts, the lack of sales in fintech, broadly speaking, globally. The sales aren't happening. So if you're going to be investing early like I am, the watchword is be patient, be very, very patient. It's no longer this 5 to 7 year term, it's more 10 to 15 years, I think, before we're going to see exits of relevance.
Yeah, Daniel?
I mean, as a founder, I think that obviously we're happy about the current valuations, because even if there's no the value or the valuation per se is not important at all, but obviously it's a way for us to be able to get down and execute and make investment in our business, and that is truly important because out comes a significantly better product. But a question back then to you is that it feels like if you look at VC returns or private equity or the likes of TCVs, that the returns of those funds is still at good or decent levels, or which I guess would then mean that the valuations over the past few years would have been on a sustainable level, or is it the other way around? No, they're actually going down, so it needs to be a correction in the market.
Yeah, I mean, let me just comment on that. I think it's a good point. One of the things, I actually read a book recently, I shouldn't plug it, you know, the Steve Schwartzman book, What It Takes, and one of the things he said was, how do you know it's a bubble? He said, well, one of the signs is that lots of people you know are making money very fast. And so I feel like, and one of the things I think about is, you said, I think you said, Philippe, everybody I know, their portfolio is doing great, right? And so that could be a good sign, but also could be a sign of something else. But Daniel, I would push back a little bit. I would say, just because if you think about the current cycle, if you're an investor in anything from 09 to 14, 15, and you're exiting today, multiple expansion just gives you return. So it's not clear to me what happens when we kind of come over that precipice. That's kind of, it's a bit early to say, I would say.
Nikhil, you were...
I feel I've got to defend public markets a little bit. So to John's point around, no company's getting the valuation, or you can't support growing companies, I'm not sure that's always the case. So if you think about where Amazon, Microsoft, Google all started, a few $100 million, I mean, they managed to sustain a degree of growth. You see that in the e-commerce sector in the UK with something like Just Eat, started off and has, through multiple capital raisings, has gone on to do what it's doing now. Arm as well when it started off. So I think there are plenty of case studies. The question is strength of the management team, pathway to profitability, and the strategic vision of the companies in question. I think there is a fair point around whether the investor base in Europe generally is prioritizing and focusing as much on these opportunities, and where we have these massive pension funds right across Europe, and how much of that investment pool is really focused on risk capital versus other opportunities. And I think that's a big question for us.
And of course, I know Philip was talking about there aren't many big beasts kind of in Europe that can afford these large fintechs, but I guess the LSE, of course, is itself listed on the London Stock Exchange, and you're in the process of trying to buy Refinitiv for $27 billion.
Yeah.
That doesn't seem to be holding you back. I mean, would you take issue with Philippe's assertion that there aren't so many big potential European acquirers of, if we describe Refinitiv as a kind of fintech or a kind of data provider?
Yeah, well, look, I think that's maybe very specific to the banks and some of the stress in the European banking system right now, which is kind of legacy from 10 years ago. But yeah, our own company, we were a few £billion company a few years ago. We're now 27 billion market cap, and we are in the process of a very large acquisition. So I think there are.
Well, you hope that it's going to be the EU competition authority is due to rule in the summer. Do you kind of expect them to wave this through? Are you confident?
I'll refer you to our circular, and so we expect the deal to close in the second half once all the relevant approvals are through. But I think for us, I think fintech is quite an important component of the future of our company. The rationale for the deal that we're doing is data is an important asset class. We want to have a multi-asset capital markets business, and capital markets are all global. You can look at those three dimensions, and you'll see that fintech will be very relevant to everything that we're doing.
I just have to ask you just one more question on that, and then I'll leave you alone on the matter. In terms of asset sales, are you expecting to have to make asset sales? I mean, I know people have talked about the Italian kind of bourse, for example.
Oh, I'm not going to get into that. So you should read what we've put out in the circular. That gives you the position.
All right. Well, I'll leave you alone now on that front. But Daniel, I think were you about to say something there?
Yeah, I think just on a comment on US, China versus Europe, which I think is a good one. If Jacob was on this panel, I guess that he would have said something similar, like, well, I went out to do an IPO where investors didn't completely understand me and gave me a valuation that was completely different. That was the kind of the real value of the company when an American, in that case, PayPal, came along. And I think that's the point in the case here.
But I think also it's interesting. I mean, we've seen in the US, for example, with Ant Financial's attempts to buy MoneyGram, for example, being pushed back by regulators. Do you? I mean, you're based in the Valley. You're more European focused. There are other two investors here. Do you get a sense that EU regulators are kind of more laissez-faire when it comes to that, and that it would be no problem if, let's say, a Tencent or an Ant Financial had come in and tried to buy iZettle, that would have been okay?
It may just be me speaking from a very, I could say, dumb San Francisco perspective, but everything in Europe seems easier. CFI US and multi-state regulation as well as federal regulation has made doing business in the United States very, very difficult. On the other hand, when I speak to regulators here throughout Europe, they do seem more ready for business and more serious about business. So if I were to back super early stage operators who want to come to Europe and are willing to move for regulation or regulatory arbitrage, it would be a good thing. But America's a tough place to do business right now.
John, you would share that?
I don't really have enough perspective, to be honest.
Okay, but I mean, you're based in Europe, so when it comes to fintech investments, I mean, Philippe was talking about the Chinese being, now let's say the European banks are out of the picture because they can't afford some of these higher valuations. Do you have any inkling that were a Chinese player to come in for fintech, that the regulators would kind of, wince and try and cause issues?
I don't know, but I would say many, and I'm involved in some, European fintechs that become large tend to have will ultimately have a U.S. presence or U.S. customers, especially if they're kind of a consumer business. And then I think the CFIUS thing would also be a factor which would be difficult to figure out. which is probably not in our interests as investors, because we obviously want the, and I think as an entrepreneur, if you were selling, you'd want the highest price for your asset. That said, on the other side of the equation, I do think to give kind of a tip of the hat to regulators, especially in fintech, my sense is that there is a nurturing environment here. I can't really comment on the US because I'm not as close, but it does feel like in the UK, in France, with BaFin in Germany, that they see an opportunity here to build these kind of local, ultimately regional, and then hopefully global champions in this category, where they've not done that historically in broader tech. So there's no Apple here, there's no Google here, but there is an Adyen, right? We've talked about this, and it's it's a real player on the global stage. And I think of neobanks, for example. I think Europe's been pretty innovative in terms of making the regulation work, relative to, say, the US, where I don't think there's been a banking license issued since 1996. I don't know if that's right or not.
There have been a couple the past few years, but nothing like this year.
Yeah.
This is a playground for innovation.
Yeah. So for that reason, I think it probably is very attractive here, and you got to tip the hat.
Nikhil?
Yeah, well, without getting into the debate around ownership, I think the really interesting question around China is their regulatory framework. I mean, they are moving quite fast to make data and financial regulation much more symbiotic, and that's why you've seen, electronic money market funds like Yubao, 588 million consumers, electronic payments taken up at a speed which surpasses anything anywhere else in the world. And I think one really big question for us is around how data is going to be regulated in the context of fintech. And at the moment, some of the applications that have been developed in China just wouldn't be possible in either Europe or the US, and that's why you're seeing the speed of growth in some of those markets.
And Philippe, unless I misremembered when we were speaking before this conference, where regarding China and the potential for Chinese companies to come in and acquire fintechs in Europe, you kind of said like that ship's already sailed pretty much, that it's too late to, even if the regulators wanted to stop them coming in, they're kind of already here.
No, I think the point that you made, Ryan, is very interesting. Fintech is probably one of the few industries where European regulation is no more complex than the US one. US, in other industries, US has a huge advantage, a huge internal market. Given the complexity of the US regulation, the state's regulation is not exactly the same case in fintech, which means that it's not a surprise that you have 3 or 4 countries in Europe with 68, 70 million people. That's where the Revolut, the N26, and all these guys appeared, because you do 2 or 3 countries and you already have a massive business. And you have a massive business with a pretty homogeneous regulation. And that's becoming more and more homogeneous. And I think that's really that's also what got the Chinese investors interested. The opportunity to build a very strong industries and more generally financial companies out of Europe. Where I fully agree with John is that there will be, and there is already a dilemma, either you build something between Asia and Europe, or between Europe and the US. It will be very difficult to build a global scale companies because of the US regulation, and probably because the regulators in the US are much more worried or against Chinese money at this stage.
Nikhil, do you get a sense that after Brexit, that UK regulation might become even more welcoming to whether it's Chinese capital or whether it's for new fintechs to come in to disrupt? What's your expectation of how things will play out?
So I think, look, on fintech, I think we've been quite fortunate actually in the UK. We've had a pretty forward-thinking regulator. They put the sandbox in place. We've been allowed to experiment in the sandbox with newer partners and test out the regulatory framework. And I think you'll see much more of that in the years ahead. And I think on the wider piece, we've always had a pretty global mindset and global wholesale market. We have obviously very large inflows coming from the US, but we also launched a connection with the Shanghai Stock Exchange last year as well. So I think the fundamental legal framework of treating investors of all nationalities equally, I think that fundamental principle will stick, and that should hopefully enable us to continue to get investment from around the world.
Well, maybe we'll see what happens with the Huawei decisions and if that has any influence. Daniel, you wanted to come in there.
I mean, it is amusing hearing about how great the European regulators are. Being the fintechs being threatened to go to jail for the past 8 years. I think that I completely understand that on a macro level that might be the case, but on a day-to-day basis, that varies a lot between different countries and so on. I think it's been quite a struggle to get, for example, PSD2 where we are today, and to be an entity in that space is, we'll do our best.
Well, Daniel, while you're talking, we obviously talked about money, and I know that's obviously the bread and butter for many of the panelists here, but obviously that's just one way that you as a startup can help fuel your growth. What to you is kind of, I mean, I don't know if there's like a hierarchy of what's most important, but I mean, obviously having a great product, or, being able to market it to the right people, having the great connections, or, having a good relationship with regulators. I mean, where do these things kind of fit in terms of what matters most to you as a startup to get growth and to become the size and scale that you're looking to do?
I mean, to us, product is everything, and when you boil it down, it comes down to the quality and the liability, or the quality of the service, the markets you cover, the engineering quality that you put out there. That is by far. So I mean, 90% of the money that we invest in the business is going into engineering. So.
Okay. And. Gentlemen, I know that you're all about the kind of, capital raisings, but I know, Ryan, you were also talking about how you kind of work more closely with the startups that you invest in, because, as we say, money is money, but you want to kind of really, almost like mentoring them, almost like an incubator.
Well, we're earlier stage than most of the colleagues here, and I think there are three things that we focus on at the outset. The first is, are you building something to solve a problem? We really want to know that there's going to be the value add of a solution to your customers and to the ecosystem. The second also is the culture that's being built in the business. I was just looking at this panel. This is probably representative of most what's happening in fintech. 5 guys talking about fintech. We've got to really think about more diversity across all metrics in order to recognize how we are building businesses globally. The final piece is, yes, it is all about money, but we have to ask the question, is what we're doing with our time going to be worth it for the long haul, especially with our early stage investments where we're taking these 10 to 15 year views. And it's key, if you have that mission and that vision in place, to the question of employee retention and customer retention. So it's those types of standards that we spend a lot of time talking to our founders about and getting going. The other thing we're finding is that there's a huge amount of capital coming in at an early stage. So a key differentiator for me and the team at Propel is we say, when you take a term sheet from us, it's an application for employment. We are joining your team. So it's also important that I manage my time and can be sure that I have sufficient hours in my week to apply and to invest in the companies that we invest in. And I often say I invest a lot of time and sometimes a little money. On top of that, I have to return a $250 million fund multiple times to keep my LP happy. So there's a lot of focus on that management too. Thank you.
John, would you echo that?
Yeah, I think we're playing a different end of the spectrum. So our current fund is 3.2 billion. So we're making about 8 to 10 investments a year, and the fund lasts for 2 to 3 years. So it's quite concentrated. And we have 60 investment professionals making those 10 investments a year. So what that means is, I think we tend to take, I would say, much more closer to the private equity end of things versus Ryan. And we're also, we're usually forced to pay a very high price by guys like Ryan and Philippe, that if we get it wrong, there's obviously an issue. So we think of ourselves as kind of the last capital in many ways that's coming in. If you're going to take that much money, the next stage you need to become a master of your own destiny. And so the two areas that we really focus on, one is well, both kind of, I'd say, fall under kind of the idea of kind of scaling your business. And the two big areas that the things that you've talked about, I think, are usually solved by the time we come in, right? Product market fit, solving a real hard problem, magical customer experience. What we really try to help with, and we have a whole operational team around this, is probably three areas. One is your go-to-market and kind of really refining that and getting efficiency into that and being able to drive growth at scale, which most companies tend to hit a road bump at some point when they get to somewhere 20, 30, 40 million, and to kind of 10x from there. And the second thing I'd say is finding people. So that the same team that brought the founder or CEO to 50 million revenue may not be the same team to get you the 500. I mean, you talked about some of the great companies over the years, the Amazons and so forth. I would argue that those teams have had multiple, talent injections to get there, and we try to be very helpful there. And then the third piece, and that's really global. If you're investing the amount we're investing, and doesn't matter where you are, the talent needs to be global if you're going to compete in the global market. And the last thing I'll just say is it's around the tech platform. Most startups, even today, it's cheap to get going. You got AWS, you got Microsoft, you have lots of opportunity, but scaling it becomes an issue because while it's very easy to get going quickly, the more you grow fast, you build up technical debt, and then from getting, again, like 10xing a business at scale with 200 people running, it creates its own issues. So that's where we try to be helpful.
Philippe, would you kind of share, do you kind of fall in between kind of these two
as we have both growth funds and very early stage funds, I share all of those concerns of my colleagues, depending on the funds. I think what John, Daniel, Ryan are saying, we need time to build great companies. And that's another issue that and it's probably the most difficult in our business. We all know that we need time, and we all know that we don't have time, or we don't have enough time.
And I think Ryan also touched on an interesting point, which was about diversity, and maybe some people have noticed that we're all gentlemen up here. But I think it was Goldman Sachs saying just the other day that they're not going to invest in companies where there aren't kind of women on the board, for example. Do you guys who are investing ever think that is some way of kind of enforcing kind of more diverse cultures on these businesses? Because I think there are kind of academic studies to show that whether it's regarding risk taking or whether it's regarding running the business, that diversity of culture and also obviously more men and more women on in higher positions is something that can actually be very good for these startups. Philippe, you're still kind of
I think we need more diversity in tech. We need more diversity in financial services, and fintech is the intersection of both. It makes it even more challenging, but I think we have no choice. It's not a matter of if, it's a matter of when. We need, I think, frankly, the VCs are really looking seriously for women talent in Europe. It's not just for pleasing our own investors. We know it's a must. We know it's very, very difficult. It will take a generation. I think it's a long journey. We even have the same issues in our own teams. More and more investors are requiring to have women partners. It takes between 10 and 15 years to really grow a partner. We need time. We are asking for patience, but we also need that it's very, very urgent, and we need to have more role models, women role models that are both that wants to become investors.
Right.
I think also just on that point, it's not only about window dressing, and I think perhaps the Goldman decision this past week could be considered to be window dressing because it's about taking companies public, but what about all the M&A deals they do and the representation of companies in between? Much of that's also been in response to regulation in California, and there's a saying that I've learned a long time ago, the way California goes, so does the rest of the United States and then the world, and we've seen some very leading edge regulation come out of the state of California dealing with the question of, for example, number of women on boards of companies, but also new privacy regulation, which is probably a lot more like GDPR than anything else. I view this as a positive because I think we can result in having better products, particularly in financial services, where the products that are developed come from a male perspective. And if you have a bit of a focus on the rest of the planet, you can recognize that there are many different types of customers. But guys like me defining products don't always have that other point of view. So I'm excited about what this means. The generational shift that we need in venture, in fintech, and in other areas is really indicative of the patience that's required. And I wonder that if we all as individuals, as investors, as regulators, do we have that patience? That's a real question I have. I don't think we do, so I'd like to really see what the outcome is in the future.
Okay. And I mean, Daniel, I mean, you obviously you're running your startup. I mean, if a VC said to you, okay, here's a check for $50 million, but you need to, have more diverse board. I don't know what the makeup of your board is. You're a Swedish company, so I'm guessing it's probably more diverse than a UK or a US board. But
as a founder, I kind of choose my management team, and the board to some extent would choose themselves because they would be representatives of the funds I want to invest. I mean, as a founder, you truly never want to compromise on finding the best candidate ever, because I think there's very few circumstances in this extremely competitive environment where you could afford that. I think, however, if I would have ended up with a management team of 100% males, then I think that I would reflect on saying it's unlikely that I ended up with the best individuals, each of these. And I'm very happy. I think that we have 40% on the management team, which are women, and happy about that.
I just want to move on, maybe a kind of more broader thing. I don't know if did any of you guys catch the New Yorker article about VC investing, talking about basically how the whole industry is postulating that the industry is broken and that VCs always come out of it, smelling of roses anyway because of the fees they take for investment, even if the investments actually go wrong, because it's actually the people putting in the money in the first place that are kind of losing it, or the kind of the people chipping in at the IPOs. Ryan, you seem to have read that, so I don't know what your take is. Is VC in general broken?
We've reached the stage of peak VC when the New Yorker starts commenting on VC. Besides being a general partner in a fund, I'm also an LP in 27 other funds. So I think I've got a good personal perspective on how funds go. And I don't think that it's fair the way that the industry has been categorized by that article. Most new funds are really focusing on keeping their fees as low as possible. It's about the results. That is how the carry models work and incentives generally operate. Now, they're going to be bad actors throughout all the industries, but I do think it's been proven over the years that this is a model that does work. If you look at the history of venture capital, the first VCs were actually the shipping magnates who encouraged the growth of those industries hundreds of years back. So we've been learning for centuries, and I think there's many ways in the future for innovation to continue to grow.
Even in whaling, maybe. It was, the article was there.
There's a lot going on in whaling, and I didn't bring that up specifically.
New innovations in whaling.
Because I do think that you start getting into fairness of treatment to animals, and my firm at least does not back whaling initiatives.
Philippe or John, I don't know if you caught it, or if you had any thoughts on the matter, but judging by the looks on your faces, perhaps not. No.
I'm actually curious to read the article. I didn't know.
Okay, well, it was an interesting read, nonetheless. I want to move on to something else. Ryan said, well, I'll move on to someone else who just spoke. Is about the exits that we've kind of been seeing. I think you were talking about there not being that many kind of exits going on in terms of acquisitions, and perhaps not many. I mean, even Nikhil, you were talking about WorldPay kind of being several years ago. So perhaps, I mean, I know there have been more recent ones, but it's not like there's been a whole kind of torrent of major exits. But we did see Visa just the other week kind of agreeing to buy Plaid for more than $5 billion. Now there's kind of lot of talk about maybe this could spark a new kind of gold rush for major fintech acquisitions, perhaps Stripe, which is valued at what, 35 billion, might be bought by somebody. Are you kind of excited maybe, Nikhil, we'll start with you, maybe excited that there are kind of, some big things that are about to happen and that could obviously be good for you guys on the London Stock Exchange, for example?
I think that, certainly from the UK perspective, there's a lot more confidence in the first half of this year than there was going to last year. Whether that's going to translate into big things happening, I think time will tell.
Okay. Philippe, in terms of M&A in the fintech space, do you think that Plaid could kind of, start things off, that we could now see, a bit of a scramble and some of these crazy valuations, to quote Ryan, maybe coming to fruition?
Maybe to throw some cold water. In Europe, generally, exit have been worse in 19 than in 18. 18 was a very special year. You had Adyen IPO. You had 2 other IPOs, including Spotify. If you take out these 3 outliers, the volume of exit was lower than in 2017. Meaning we still have a long way to go. I am pretty optimistic because of the quality of the companies. Frankly, I have no global solution because there are tons of very well performing growth stage private equity based companies. Frankly, I see no solution for huge liquidity in the short term.
Okay, well, there's a bit of a wet blanket over that. But John, what do you think?
I tend to have similar view to Philippe. I would say a couple of things on that. First off, there's a lot of capital in our industry, right? So whether it's VC, we talked about it earlier on, there's just so much capital looking to invest in private markets. And I would argue that probably a lot of those companies won't be successful. That's the nature of the risk, the bet, which we'll see over the course of the cycle. You'll have to have failures as well as successes. That's otherwise pricing goes crazy. I do worry that so the Visa thing caught my surprise. Didn't expect that. And I've seen those guys be quite active even since then. They've a couple of small investments here and there. But I wonder where the buyers are for most of these companies. And so there aren't that many companies that can fork out. It's kind of a weird kind of spiral where you have a lot of private money forcing the valuations up, and then no buyers. The public market guys not being valued, as Philippe said, in a way that they can buy these businesses. So what does that mean? I think it means, one, you need to be backing companies that can ultimately be self-sustaining. And then 2, I think you need to be able to back companies that, I think you made a great point, that have enough time, right, to kind of grow into, because even in the course of a cycle, if you back the right company, if the market's big enough, the team's good enough, they will grow into a valuation that makes sense. That's the trick that I think we're all trying to figure out, and I think we get it right sometimes and we get it wrong sometimes. But I don't think we're going to see a flurry of big M&A deals, only because we don't have the buyers, and we also, the buyers that we do have, whether it's China or so forth, are being restricted. So it's kind of a catch-22 in a way.
Right, Ryan, no gold rush for exits?
I think there's going to be a gold rush in the range of $100 million to $200 million. At least if you look at the US outcomes right now, that's where the sales are. And that tells me get in early, stick around at the right valuation, still be patient, and you'll get a sale price of 100 to 200. But $5.3 billion by Visa is not going to come across every year. It may come around every 5 years to every decade.
Okay, well, we've got kind of like just over 5 minutes left. The clock actually resets, so I'm just going to go by the clock for now. In terms of the next big thing that you're looking for, whether it's in terms of fintech investment, where are you focusing in terms of your investments? What do you feel is like the next kind of really ripe area for you to go in if it's not too much of a secret, and it's going to get everyone else to pile in as well. And also in terms of your industry, Daniel, as well, maybe you can also give us a sense of where you think your startup is going and where you see things going, and Nikhil as well. So let's start on the end there with Philippe.
I think what I find the most surprising is the quality of the founders. And I think we see very, very interesting opportunities around the utilization of data in financial services. I think that's only the beginning. It will be so powerful that it might become scary, but at least the technology is there. And a lot of the young fintech companies have understood the value of those data.
Well, that will be no doubt music to the ears of Daniel and also Nikhil. Daniel?
Thank you. And I mean, for us, it's all about doubling down on our investment to be the European open banking platform, going from 30 markets to full coverage across Europe, to do both the payment aggregation everywhere, to do not only PSD2 data, but the assets and liabilities, and more importantly also, everything from data cleaning to credit scoring to insights about the data that comes on top.
Nikhil?
I think 2 points. One is how public markets invest. So a bit of a digression, but musical royalties are now funded through investment trusts on the market. They start off with 150 million, one big one, and now it's $1 billion plus. You've seen the first fintech investment trust come, Augmentum, and to see how they go. But that could be one way for pension funds and others to get involved. In terms of the technology, I think 2 areas where I think we will see some big shifts. One is where fintech aligns with other trends. So the fintech, regtech space, I think, could be very interesting. We are seeing artificial intelligence, machine learning being used far more in our own activities, on market supervision, on compliance and reporting, on all of those things. The second area is green, where you will see green tech when fintech come together, particularly in the insurance space, where I think you could see some very, very big players emerge in the next few years.
John?
Yeah. I'm probably not as good on the early stage stuff as some of these guys. So for me, last year on this stage, I think we said that, well, one of the things that we like, if you look at what TCV's done over 25 years, we've followed industries that have had kind of, say, digitization take over the industry, whether it's Netflix, Spotify, LinkedIn, you name it. And I think that's happening in financial services and banking. And I think I still think we're very early in that phase. And so we have skin in the game. We backed Nubank since then. So I think we will continue to look for those type of assets. And I think there's a long way to go into kind of digital banking space, broadly speaking.
Okay. Ryan?
So I'm probably going to be repetitive over here. For me, at an early stage, venture capital is human capital. The most important thing I can do is back the right founders who have big ambition and want to work really hard on what they're doing. I do think the leading area is going to be data-led innovation in financial services, with more of a focus on the tech and fintech than the fin and fintech. And by that I'm saying really scalable technologies that help these businesses grow, as opposed to pixel perfection on the front end and the UI. We also want to go a lot earlier at Propel. We're going to focus on incubation and EIR programs this year more than ever. There are a number of very experienced professionals who want to move on to their next big thing, but don't really know what that is yet. And I want to be sure that I've got a good home to welcome them in and to partner with them for the next decade.
Okay, well, that was a really fascinating discussion. I want to thank all of our speakers here for joining us. That was Nikhil Rathi, Daniel Schellen, Philippe Collombel, John Doran, and Ryan Gilbert. Thank you all very much.